The trap is set. We're looking at a veteran metals analyst warning that what's coming next for silver. Well, it might be a deliberate, short, and pretty violent market shakeout, designed apparently to flesh out every weekend before what he thinks could be the biggest rally in half a century. I'm your host, and today we're digging into the critical insights from veteran metals analyst David Morgan's recent warnings. He's not just predicting some volatility. He seems to be describing a very precise, calculated psychological move in the silver market. It's all about timing, really, and survival. We want to help you understand the dynamics here.
Yeah, and we really have to frame this within the bigger picture, the geopolitical one. Morgan's prediction, this manipulated drop he's talking about, it doesn't happen in a vacuum. It tends to happen when the system is weakest. And right now, well, we're seeing a foundational breakdown, really, of the financial system worldwide. When central banks, nations lose faith in sovereign debt, they start shifting assets around. Silver's kind of the final small market left to really move after gold's already taken off.
Okay, that sets the stage perfectly. Before we zero in on the timing of this potentially brutal moment, look, if you find this kind of targeted market intelligence useful, especially navigating these complex markets, just take a quick second right now, hit that subscribe button, and turn on notifications. It really helps us keep this knowledge flowing directly to you. So let's start with Morgan's core belief here, the thing that underpins this whole warning. He basically argues that the primary function of any bull market isn't really to reward everyone, but specifically to, quote, shake off as many participants as possible. It's almost like an act of resource transfer.
Oh, it's entirely about that. It's maximizing the wealth transfer from, say, the retail investor to the big institutional players. Morgan's expecting a shakeoff in silver that's short-lived but significant. He actually points to October as a key risk month. Seasonally, he thinks.
October. What October specifically? Is there a historical pattern there? Or?
Well, he suggests it often correlates with a kind of temporary shift in algorithmic sentiment, and he thinks it's designed by the bullion banks.
Right, the algorithms. We hear about banks manipulating prices, but how do these algorithms actually do it? It's got to be more complex than just, someone hitting sell.
Oh, way more sophisticated, yeah. These algorithms, they're proprietary, obviously, but they're programmed to spot a couple of key things. Huge retail buying volume and those big historical price barriers. So they might push the price up fast, maybe create some initial excitement, euphoria even, and then near a key resistance level, they execute massive, very visible short selling. It floods the market. The aim, trigger the stop-loss orders of all the newer investors, the ones who just jumped in, maybe haven't seen this kind of volatility before.
So it's basically engineering panic, create that instant fear, get retail selling.
Exactly. And then the same players, the banks, they step back in and buy the physical metal, the real wealth, cheap.
It's the oldest game in the book, just, with fancy software now. The volatility isn't an accident. It's the tool.
It's the tool, designed specifically to scare out the new people, or weak hands, as Morgan calls them. And to really get where we are now, Morgan says, look back. Look at history. He stresses that silver always lags gold at the start of a big bull cycle. The last major run is like the perfect example.
That was the early 2000s, right?
That's the one. Gold's bull market really kicked off in 2000, early signs of monetary trouble brewing. But silver, it was just stagnant. It didn't properly break out until September 2003. That was when it finally got above the $5.55 saw level.
Wow, a 3-year lag. That's significant.
It's huge. 3 years of watching gold climb, wondering if silver would ever join the party. But, patience paid off. Once silver broke that $5.55 ceiling, bam, it launched an 11-year bull market. And in some of those years, silver actually outperformed gold by quite a bit. The lag was long, but the catch-up, explosive.
Okay, so fast forward to today. The comparison is, well, it's pretty stark. Gold has just blasted past $4,000 an ounce. I mean, a level many analysts thought was maybe a decade away. That move's already pricing in huge geopolitical risk, systemic risk. And now silver is pushing hard towards $50. So Morgan sees us right at that same kind of crossroads as 2003. The lag is ending, and this smaller, faster market is coiled up. Okay, this is where it gets really interesting, moving from history to what might happen next. Let's talk about that key indicator Morgan uses, the gold to silver ratio, the GSR.
Right, the GSR. He uses that as his kind of ultimate measuring stick. It literally tells you how many ounces of silver you need to buy 1 ounce of gold. Right now, that ratio is, well, it's stubbornly stuck in the mid-80s.
Mid-80s. And historically?
Historically, that's extremely high. It screams that silver is still deeply undervalued compared to gold. In a real monetary metals bull market, that ratio has to come down. It just has to.
So Morgan has a target for that ratio?
He does. He says he won't be, quote, particularly happy until the ratio hits 70.
70. Why 70? Is that just a historical average, or is there something else going on there?
It's partly historical, yeah. 70 is often seen as a sort of equilibrium point where the market feels silver is fairly priced based on supply and its monetary role. But the key thing now, getting to 70 means the market is finally starting to price in the huge industrial demand. Think solar panels, high tech, stuff that just wasn't as big a factor back in 2003. So yeah, 70 is his first major target for the ratio.
And if we translate that, a 70 ratio with gold where it is today,
Hmm.
what does that mean for the silver price in dollars?
Well, roughly, you'd be looking at around $55 silver. That's the kind of breakout price point he's watching. But to get there, you first have to shatter that massive psychological wall at $50.
$50. Morgan calls it the crossing the Rubicon moment.
Hmm.
You mentioned earlier silver hasn't stayed above that level for 50 years. Why is that specific number so heavy psychologically and for the algorithms?
Yeah, 50 years is a long time. It represents this huge historical ceiling. If you shatter that and
Yeah.
crucially hold above it for a decent period, the whole market psychology shifts. You enter what he calls blue sky territory. Suddenly, every single long-term holder, no matter when they bought over the last 5 decades, is technically in profit. That switch from sort of collective trauma to profit, it generates really powerful momentum. It feeds on itself. Plus, those trading algorithms we talked about, they're programmed to respect these long-term highs. Breaking $50 signals to the machines that the game has fundamentally changed.
And it really highlights why preparing for this shakeout he expects is so critical. We're right on the edge of this Rubicon moment, as he puts it. Gold's already led the way. So the question isn't if things are moving, but how rough the ride might be, and if you're ready for that planned chaos. Look, if you own gold or silver, or you're even just curious about this space, this is absolutely the time to stay informed, not fearful. This feels like a good point to just underline that need for readiness. Make sure you hit that like button, subscribe if you haven't already so you don't miss our ongoing analysis of what could be coming next.
Absolutely. Preparation is everything, especially because Morgan emphasizes that, it's different this time. It's not just another cycle. That financial system breakdown we mentioned, it's happening everywhere globally, which is why you see this sector rotation starting with the big players, the central
Right?
banks.
We saw the central banks piling into gold years ago, basically validating it as that ultimate risk-off asset. But now silver's catching up. Are there risks in how it moves? Is faster always better?
That's exactly Morgan's concern about market health. He actually fears a totally reckless parabolic surge, just a vertical line straight up on the chart. Why? Because that kind of move leaves no support, no base underneath it. It's structurally weak. Those kinds of spikes often collapse just as fast as they rise, and they can wipe people out.
Okay, so he prefers a more measured ascent,
Yeah,
building support along the way.
exactly. Consolidation. He'd much rather see silver trade sideways for a bit, maybe build a solid base between, say, $44 and $47 through the end of the year. That consolidation creates a new, higher price floor. It gives psychological support, technical support. It lets the short-term profit takers get out, and it provides a much stronger launch pad for that explosive next leg up, the one that comes after the potential shakeout.
And while maybe the average investor is watching these price ranges, the big institutions, even nations, they're quietly stacking, aren't they? Let's talk about that geopolitical accumulation, because that must change the underlying stability here.
Oh, absolutely. And this might be the most compelling sign that silver's future isn't just a repeat of the past. You see massive stacking in China and India, for starters. China is this interesting, it's kind of dual purpose. Strategic, yes, but also huge industrial demand. High-tech manufacturing, solar panels, they devour silver.
Yeah.
India, more investment driven. Cultural affinity. Plus, new silver ETFs are making it easier for their growing population to preserve wealth there.
But it's not just individuals or even just industrial users. There are bigger, more strategic moves happening.
That's where it gets really eye-opening. Take Saudi Arabia. Quietly, they picked up nearly 1 million shares of SLV, the big silver ETF. Now, the crucial part isn't just owning the shares. Owning that much potentially gives them the right to demand physical delivery of the silver. That signals a clear desire for the actual metal, pulling wealth out of the paper promises and into the real world.
Wow. And Russia. Are they playing in this space too?
Yep. Russia continues to add silver, and platinum too, to its national reserves alongside its gold. When you see this kind of coordinated or at least parallel accumulation by institutions and nations, it's a major signal. These big players see how small the physical silver market really is. They know once the broader public fully wakes up, the move could be incredibly fast because there's already this institutional floor being built.
Which brings us right back to that final trap Morgan warns about. The ultimate shakeout might be engineered as a fake out, right? Like push the price up near 50, say $49, get everyone excited thinking this is it.
Euphoria sets in.
Exactly. And then slam the price back down hard, maybe to $42, $43. Just enough to trigger panic selling from those weak hands.
Right before the real run, the one that breaks $50 and heads towards $55 or higher actually begins. And that, really, is Morgan's final question aimed directly at you, the listener. He asks, when that dip happens, maybe silver hits $42 or $43 during this engineered volatility. What do? Do you panic? Do you sell into the fear, thinking the rally failed? Or do you recognize it for what it might be, the last big shakeout, the final planned buying opportunity before the major breakout?
His message seems crystal clear. The smart money, the institutional money, they wade through this kind of noise. They understand the game. And this next phase, he argues, won't be a slow, decade-long grind. It's likely to move fast, burn hot. The institutions and nations, they're already positioned. They aren't selling into fear. They're looking past it. So here's a final thought for you to mull over as you process all this. Given that these major nations, central banks, huge institutions are all quietly accumulating physical silver, does that underlying accumulation fundamentally change the risk of this potential October shakeout? Does it make it less about random volatility and more about a planned, perhaps even inevitable transfer of wealth from those caught in the panic to those who are prepared for it? Something to think about.